Hello, good day everyone. I am Lonnie J. Sales, BSBA Financial Management Tutu. I'm here to discuss the three topics under the Chapter 3 that is all about financial statement, cash flow, and taxes. Without further ado, these are the three topics that I will elaborate for this discussion. First is the FCF, second is the MBA, and third is EVA. FCF stands for Free Cash Flow, MVA stands for Market Value Added, and EVA stands for Economic Value Added. Here the list of references that I use came from books and website. First is authored by Besley S. Billingsley, R.S., Brigham E.F., Dittman L.J., Joint M.D. 2017, Business Finance, Joe E.S., Publishing House Incorporation, Dalandan, Valenzuela, Philippines. Second is authored by Brigham E.F., Huston J.F., HSU, JM, Kong YK Arifin ABB 2019, Essentials of Financial Management 4 edition, Sage Learning Asia PT Ltd, Taguig City, Philippines. From website preferences, contributed by Chen J, 2019, April 17, the economic value added EVA retrieved from https www.investopedia.com terms EVAS ASP. Free Cash Flow FCFs 2019 September 13 retrieved from https instagramanswers.com dictionary free cash flow and contributed by Jaggersaw JA 2019 May 20 Free Cash Flow FCS retrieved from https www.investopedia.com terms F Free Cash Flow ASP. And lastly is Market Value Added MVA Overview Formula Advantage 2015 retrieved from https corporatefinanceinstitute.com resources knowledge valuation market value added MVA. With these references, I believe that the topic that I will be discussed is accordingly, accurately, and precisely, of course, interesting as your lecturer and of course my listener for today's video. Here are the learning objective in my discussion. First is to discuss the concept of free cash flow, market value added, and economic value added. Second is to introduce the equation or formula used to calculate the free cash flow, the economic value added, and the market value added. And lastly is to give an example of problem solving in free cash flow, in market value added, and in economic value added. Before we proceed to my discussion, let me give a short recap on the previous video presenter that tackled about the income statement, the operating income, the amortization, the depreciation, the balance sheet, and the statement of cash flow. First is the income statement. Income statement is a report summarizing the firm's revenues, expenses, and profit. Generally, this income statement was done quarterly or yearly. The operating income is an earning from operation before the taxes and the interest. The depreciation is the charge to the cost of asset depleted in the production process, and also this depreciation is not a cost outlay. The amortization is a non-cash charge similarly to depreciation, except that the amortization representing a decline in the value of the intangible asset. The so-called balance sheet is a statement of the firm's financial position at a specific point in time. Lastly, this is the statement of cash flow. The statement of cash flow is a report that shows how items that affect the balance sheet and the income statement how affect the firm cash flow. With this past information, it will be used to my discussion about the free cash flow, the market value added, and the economic value added in terms of using the table for the solving. Data help us to understand and analyze and of course improve the business process. so that we can reduce the waste of money and waste of time. According to Brigham et al. 2019, the corporate decision makers and security analysts often modify the accounting date or accounting time so that they can meet the expectation and their needs. The data processing is important because it helps to increase the productivity, the profit, the better decision, the accurately and reliable information. Further cost reduction is in storage, distributing, and report making by assessment and by accurate presentation is one of advantage of having a data. With that, the free cash flow, the market value added, and economic value added will introduce and discuss because the market assessment value takes into account its about the operation, the current operation, and the future opportunities. In line with the body of my topic, these are the table used by the previous presenter. First is the Allied balance sheet, composed of asset of 2015 and 2014. The table 2, the table 3.2 of Allied Products income statement for year ending December 31. $1,000,000 except for per share data. Year 2015 and year 2014. Here is the table 3.3, the Allied Food statement cash flow for 2015. Free cash flow. According to Jaggerson 2019, free cash flow represents the cash a company generates after the accounting for cash outflow to support operation and maintain capital asset. The free cash flow is a measure of profitability that excludes the non-cash expenses from the income statement and includes the spending on equipments and assets as well as the net working capital from the balance sheet. It is also defined as the amount of cash that could be withdrawn without harming a firm's ability to operate and to produce the future cash flow. The free cash flow equation or the formula used to calculate free cash flow is free cash flow is equals to EBIT, stands for earning before income tax, times 1 minus tax plus the depreciation and amortization minus the capital expenditure plus change in net operating working capital. The change net operating working capital is also computed or also equal to change in current asset minus the change current liabilities minus the notes payable. Example, looking at the Allied's key financial statement, we can collect the pieces that we need to calculate. First, we can obtain the Allied's EBIT or earning for income tax and depreciation and amortization expenses from the income statement. Looking at the table 3.2 that I already presented, we see that Allied's 2015 operating income was $283.8 million. Because Allied tax rate is 40%, it follows that its NOPAT or equal to EBIT times 1 minus T is equals to 283.3 times 1 minus 0.4 converted of 40% to decimal point is equals to $170.3 million. We also see that Allied's depreciation and amortization expenses in 2015 was $100 million. In the given example, the change in NOWC or the net operating working capital is equals to change in current asset minus the change in current liabilities minus the change in notes payable. NOWC in 2015 is equals to $1,000 million minus $310 million and minus $110 million is equals to $800 million. Likewise, its net operating working capital for 2014 can be calculated as NOWC 2014 is equals to $810 million minus $220 million minus $60 million equals $650 million. Thus, average change in net operating working capital is equals to $150 million times $800 million minus $650 million. Putting everything together, we can calculate the Allied's 2015 free cash flow using this general formula. The free cash flow of 2015 is equals to $173.3 million plus $100 million minus $230 million plus $150 million. Free cash flow is equals to negative $109.7 million. Allied's FCF is negative, which is not good. According to Brigham et al. 2019, free cash flow can have a positive level and negative level. If it is in a positive level, it means that the company has more than enough money to finance their current investment in fixed asset and in working capital. While if it is in a negative level, it means that the company have no sufficient money to finance their current investment in fixed asset and in working capital, so that the company will find another money in the capital market to pay their current investment. Therefore, the free cash flow calculation is important and more critical in terms of the capital in the firm's capital budgeting analysis. Market value added is the amount of wealth that a company is able to create for its stakeholders since its foundation. In simple terms, it is the difference between the company market value of stocks and the initial capital that was invested in the company by both stockholders and bondholders. The equation used to calculate market value added is equals to market value of shares minus book value of shareholders' equity. Market value of shares simply multiply the outstanding number of shares times the current market price of share. Take note that if the company owned a preferred shares and the ordinary share, the two should sum up to find the total market value. For example, consider company XYZ whose shareholders' equity amounts to $750,000. The company owns 5,000 preferred shares and 100,000 common shares outstanding. The present market value for the common share is $12.50 per share and $100 per share for the preferred shares. Market value of common shares is equals to 100,000 times $12.50 is equals to $1,250,000. The market value of preferred shares is equals to 5,000 times $100 is equals to $500,000. The total market value of shares is equals to $1,250,000 plus $500,000 is equals to $1,750,000. MVA is equals to market value of shares minus the book value of shareholders' equity is equals to $1,750,000 minus $750 is equals to $1 million. The market value added is equals to $1 million. Take note that the high market value added means that the company is generating enough wealth, so it will attract more investors. By this, the company expands their operation, earning more profit, and of course, they stay ahead on their competitors. Economic value added. According to Chen Ji 2019, economic value added is measured of a company's financial performance based on the residual wealth calculated by deducting its cost of capital from its operating profit, adjusted taxes on a cash basis. This economic value added is also referred as economic profit because the other company attempts to know the true company's economic profit. And EVA is also an incremental difference in the rate of return of the company's cost capital. Essentially, this is used to measure the value of a company's generate from funds invested into it. Equation used to calculate economic value added is equal to net operating profit after taxes, or also known as the NOPAT, minus annual dollar cost of capital. Or EVA is equals to earning before income tax, EBIT, times 1 minus tax rate minus the total invested capital times after tax percentage cost of capital. For example, Company ABC generated after tax net profit amounting to $200,000 in 2018. The amount of capital the company invested was $2 million at an average cost of capital of 8.5%. To calculate ABC's economic value added with the use of the general equation of economic value added is equals to earning before income tax times 1 minus T minus the total invested capital times the after-tax percentage cost of capital is equals to $200,000 minus $2 million times 8.5% is equals to $30,000. The economic value added is equals to $30,000. According to Brigham et al. 2019, if the economic value added of the company is positive, it means that the company is producing value from its from the invested funds into the business. Conversely, if the economic value added of the company is negative, it means that the funds invested into the business is not generating. To summarize my discussion about free cash flow, market value added, and the economic value added, first is the free cash flow is the amount of cash that could be withdrawn without harming the firm's ability to operate and to produce the future cash flow. And the market value added is the excess of the market value equity over its book value. And the economic value added is the excess of the NOPAT, or also known as the net operating profit after tax over its capital costs. I conclude that the free cash flow, the market value added, and the economic value added is really important to be known by the company to have a sustainable development, high quality net income, and a reasonable and wise decision making in use of the concept and the equation. Also, we the students to become a future top managers of the business world. Thank you for watching my video presentation. I hope you understand and learn something.